Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and also Portfolio Manager. Thank you for this week's Market Carver, where we're going to go over a few of the things we talked about in this week. We got 4 bullet points for you, a couple around the Fed and inflation points, and specifically on the Fed rather than interest rates. We're going to talk about the balance sheet and the shrink there. The CPI release of last week was, again, eye-popping. And then Andrew's going to come in and talk about sector inflection points in the S&P 500 and just a little bit of a teaser. We would certainly label this as good news. So at least rather than clicking off as I dribble off my points, stick around for some good news that Andrew will have for you. But first, we'll start off with the Federal Reserve. Not just the Federal Reserve, but central banks around the world. If you go back to the great financial crisis in 2008, one of the extraordinary measures was what we called quantitative easing. And that simply meant that the Federal Reserve would do something that they had not. They would take their balance sheet, which was $800 billion, and they would use it. That $800 billion was very passive, and it performed very vanilla functions at the Federal Reserve, but they decided to take an active role and buy up a bunch of assets. And then they just kept going. Not only the Federal Reserve, but the Bank of Japan and the ECB and the Bank of England, all of them collectively would go out and buy a bunch of assets in an attempt to really help fuel along this cycle. And of course, it exploded in around COVID. Now, in doing so, they run the risk of exploding the money supply and fueling inflation, which of course now we're wrestling with. So one of the certainties that we're seeing behind this phase is that the central banks then would unwind those assets. So the focus becomes on interest rates, and we're always talking about whether we'll have a half a point, 3/4 of a point, or even more by the Federal Reserve. Behind the scenes, this is slowly but surely equal or potentially even more important of a factor as they wind down. They let the assets mature and perhaps at some point in time actually sell them. I was finishing up the conversation here. This is Tuesday afternoon with an industry fixed income expert, and we were together discussing how this could very well be a more useful tool in the Federal Reserve and how they might just need to be selling assets. If that were come, that would be a wrinkle. But either way, this is going to be as big or bigger factor than interest rate increases. Because behind the scenes here, we still have extraordinary CPI releases. So the headline was at 9.1%. We've got all the different components here, but the punchline is that energy continues to be a very painful and visible reminder of the acuteness of the high inflation rates we have. Gasoline up 60% year over year, leading the charge, as is household energy. We're at 22%. And Andrew's been right out front with the problems that we've seen in Europe. And sadly, places around Europe would love to have 22% household energy inflation. On the good side, we are seeing a turning point in some of the other areas which were heavily. Used cars and trucks, major appliances, beginning to see some softness there, particularly where goods are involved and we have a lot of inventory. They're still very high levels, but at least they are starting to trend the right direction. Energy can be a volatile component and is certainly at 9.1%. All to say, it's very likely that the Federal Reserve follows through with another strong interest rate increase and with certainty continues to let their balance sheet shrink. So shifting now to the equity markets and sectors, one of the things Andrew shared with us this Monday was an important setup for several of the sectors. So Andrew, I'll pass the baton to you.
Thanks, Adam. Yeah, so we'll often on these videos and often in our Monday meetings, we're always talking about the S&P 500 or the NASDAQ. We often talk about the broad indices. We always never want to forget something we're always reviewing as well, but maybe gets a little less attention are the individual sectors and the trends within those sectors. There's 3 that actually stand out the most to me right now. And interesting enough, the 3 of them are probably some of the most economically sensitive sectors. On the very top, we have XLY, consumer discretionary, XLF, the financial sector, and XLI, the industrial sector. We're going to talk about those 3 first. And all 3 of them right now have had their prices come down, just like when we talk about the S&P 500, how that has come down. And they're at a really important potentially an inflection point here on the chart. We can see that blue line, if we go all the way across to the left, is right at that 2020 high, right before the COVID crash in March of 2020. And so we've seen now prices in these three key sectors pull back to that level. What we want to see from here is support hold in. We want to see buyers come back in, see that maybe there's a value opportunity in some of these areas of the market, and we want to see that 2020 high. We want to see that hold as support and see these sectors bounce higher. Now, of course, there's always the potential that that doesn't happen. And if instead we start seeing that these three sectors break below this 2020 high, then that could start giving us a little bit of a hint, a little bit of a warning that maybe we're going to see another leg lower in the broad market. Because if we're starting to see continued weakness in consumer discretionary, financials, and industrial stocks, again, those sectors that are pretty economically sensitive, then that's telling us that we're continuing to see potentially that the economic data is starting to cool and slow. Unfortunately, that continues to be the case. Right now, we're just starting the earnings season for Q2, and so there's a lot of catalysts that could really get these sectors to move in either direction. If we get some good numbers, maybe we see this support hold. If we get some bad numbers, some bad reports, then maybe we see a break lower, similar to what we can see on that chart XLC. That's the communication sector, and it's already broken below its 2020 high. And we've seen several that happen to a couple other sectors as well. But the three that I'm most focused on right now, consumer discretionary, financials, and industrials, they're sitting right at that fork in the road, and we'll see over the next coming weeks which direction they take from there. Finally, want to look at the one last chart we have here is looking at historical market performance. We don't have to tell you that the first part of the year, those first 6 months were pretty bad. In fact, it was the fourth worst start to a year, the fourth worst 6 months, actually since the Great Depression. But there is as Adam said at the start of the video, there is some good news in that. So when you have a really bad period of time, historically, the markets follow that up with a pretty good period of time in market performance. But it's for those that have longer term investment horizons. What we can see on this chart here is on the far left side, we can see the worst 6 month periods going back to 1971 for the Wilshire 5000, just a very broad gauge of the equity market. And we can see how the market performed over the next 3 and 6 months, 1 year, 3 year, 5 year, and 10 year. And what you'll see is there's a lot of green in the 3, 5, and 10 year, in the 1 year as well. But what we want to focus on is that 3 to 10 year period. What we're always stressing, being focused on the long term, setting our plans to be long-term focused, because that's where we can get the most edge from compound interest. We can see after these really bad 6 month periods of time that the market has put in some really solid performance over the next 3 to 10 years. As people come back to the market, as the long-term trends continue to go higher. So since 1971, of course, past performance is not indicative of future return. We can't say just because it happened during this period of time, it will guarantee to happen going forward. Unfortunately, we can't make those types of claims, but we can use market history as potentially a guide path for what's going forward. That when we have really bad periods of time, that there could still be a light at the end of the tunnel. Maybe we just have to get a little bit further runway in front of us before we can get that takeoff, so to speak. But historically, we have seen some pretty solid returns when we go out 1, 3, and ideally 5, 10 years. The market does start seeing some green. So something maybe for us to look forward to in the future.
Thank you, as always, Andrew, and thank you to all of you for giving us a few minutes of your time this week. Always appreciate that, and giving us the opportunity to stay connected and keep you apprised. That's one thing. We can't always control what's going on in the market, but we will be transparent and share with you what we're doing each and every step of the way, and our thoughts on how we're going to proceed. Don't forget to schedule your meeting. Hopefully we've got something on the books if we haven't seen you already for your annual family update. But if you need to get in and see us, please give us a call, 800-928-4001, or scan the QR code. And then lastly, don't forget our weekly radio show over the airwaves on WIBC and a couple other stations, or if it's more convenient for you, through however you get your podcast. So thanks again, and have a great weekend.